Hi, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastori. There are plenty of signs out there that the Fed may be getting close to easing their aggressive tightening cycle, even though Jay Powell continues his comments about how, quote, it's very premature to think about pausing. He also said somewhere along the way, we're nowhere near a pause. Plus, what might be the impact on markets, currencies, and of course, the big word that we're all talking about these days, inflation. So we're going to discuss all of that right now with my guest for today's show, Bill Sterling from GW&K Investment Management. He is a global strategist there. Bill, lovely to have you here in the studio with me. Thanks for joining us.
Great to be here. Thank you.
Terrific. You and I were just talking before the show. The Fed certainly has a lot on their plates. And of course, we know their mandate is employment and inflation. And volatility and inflation clearly have been the two big words of this entire calendar year in the markets. Maybe you can get us up to speed on your analysis on how we got here.
Well, I think nobody this year had 9.1% June inflation on their bingo card. That's for sure, right? But, if you look at the confluence of $5 trillion of fiscal stimulus that hit the economy with a lag, and then you had supply shock from the Ukraine war, you had supply shock from supply chain problems around the world, and then you've had this massive labor supply issue where, we're right now, the civilian labor force is 4 million people less than the trend would have implied at this point. And whether that's baby boomer retirements or long COVID or whatever, it's a huge shock to the labor market.
It's interesting one of the things that I really appreciate, I read a recent report that you authored, and you put a bunch of really interesting charts, which we're going to pull up here in a moment, talking about the history of Fed cycles and when they typically pivot. Because the question that keeps coming up now from ourselves, our investors, is when will the Fed begin to reverse course? Now, at this point, we've got the meeting coming up on the 13th and 14th of December. Here it's in UBS, our chief investment office does expect the Fed will hike 50 basis points instead of the 75 we've done the last couple of meetings here, which I think is pretty well thought by many economists. But when you look at the history of Fed cycles and pivots, what does history tell you about when the Fed right now might be either finished or starting to pivot a little bit here?
Well, first of all, I define a pivot just as the date of the last rate hike. So whether that's next week, whether that's in February, whether it's in March, we don't know for sure. But when you look back to the early 80s, there have been 6 pivots by that definition. And when I looked at data like the unemployment rate or price inflation trends, those didn't give great immediate signals of a pivot. But what I found was if you look at the yield curve, when it inverts, you're often a few months away from that pivot because it's telling you that monetary policy has finally become very restrictive. We've now got 2s and 10s and 3s versus 10s, both about 80 basis points inverted. So that's telling you that Mr. Market already thinks policy is quite restrictive.
It's the biggest difference since like the 80s, 84.
Absolutely.
Yeah.
You have to go back that far to see that big of an inversion in the yield curve. So that's a signal that suggested to me, I wrote that piece in late September, early October, that the pivot could come sooner rather than later. Because there's a kind of a cat and mouse game between investors. We have to listen to what the Fed says. We certainly have to respect what they say. But we also have to guess what they'll actually do. Like Mike Tyson said, everybody's got a plan until you get punched in the nose, right?
That's
so
right.
What happens when unemployment starts rising? What happens? We're already seeing layoffs surging. They doubled according to the Challenger Gray.
That's right.
Data in November.
Especially coming from the tech industry.
Yeah, and Bloomberg tracks the number of layoff stories, and that's back to where it was in May 2020 during the pandemic recession. So, who knows if that's accurate or not, because the trailing labor market data has still been very resilient, as you know. But something is brewing, that's for sure. And I think the market is sniffing out that the weakness in the economy could come perhaps sooner rather than later.
Yeah.
Hence a pivot, potentially as early as the first quarter.
Right. I mean, the most recent jobs report that we saw for November, we still saw growth in jobs. Unemployment was very tame.
Right.
So the Fed really has to think long and hard about the path forward because it's very data dependent, as they've been saying all along.
Yeah, they very much don't want to make the mistake from the 70s, the so-called Arthur Burns blunder, where he eased prematurely and then inflation just went ripping along.
Right, that would be I think the worst thing for the Fed right now, especially since where we've been, where a lot of economists and other strategists have said they probably started the tightening cycle a little too late in the game, so they don't want to make another wrong turn here. But another report that you wrote was talking about the strength of the U.S. dollar, which versus the euro and the pound, some of the major currencies, it's been fairly strong, not compared to history of the dollar, but compared to where those other currencies are today. But you also said that when you look at the dollar, a stronger dollar could potentially help curb inflation. What do you mean by that? And are we in that cycle right now?
Yeah, well, as of mid-October, the dollar was up 20% year on year against the DXY index. It pulled back about 7% in November, but it's still up roughly double digits year to date. And when I went back historically and looked at periods when the dollar had surged more than 17% on a year-on-year basis, which is roughly the 95th percentile of strong dollar periods, I found a couple of things, which is you tended to get pretty reasonable equity and bond market returns after that surge in the dollar, because the dollar conceptually is a machine for driving the inflation rate down. Clearly it can reduce the price of imports, although it hurts our export industries as well, and that's probably a bigger impact. The New York Fed did a study a few years ago and said for a 10% surge in the dollar, you knock something like 0.5 to 0.7% off of growth for the next couple of years, which means you're feeding into unemployment rising, which is what the Fed wants right here.
Right, of course, at this point.
And then there's a bigger sense, too, which the dollar is deflationary for the global economy, because a strong dollar is a weak currency for other trading partners of the U.S., which puts inflation pressure in their court and forces them to raise rates. So you end up getting a simultaneous rate hike, synchronized rate hiking cycle around the world, where the parts can be bigger than the whole can be bigger than the sum of the parts, I guess, put it that way. And that's something I think a lot of economists are now concerned about. You've got inverted curves in the UK, inverted curves in Europe, an inverted curve in Canada. So there's a lot of tightening around the world, not just the U.S. here.
Right. Global central banks have been quite busy trying to keep their own monetary policy issues at bay, right, without making it a global issue. But of course, it's becoming one. I mean, you can't, like you said, Ukraine is an issue. The supply chain issues out of China, although China looks like they're starting to loosen a little bit of their restrictions on people leaving their homes due to the COVID lockdowns that have been going on for 3 years there. So maybe there's a turn. And maybe before I even get to the last question for you, do you think we've peaked here? Have we seen inflation peak at this point?
I think it probably has peaked, and I think the big question for both the Fed and private sector economists is, it's easy to see the drop from 9 to 4 as being pretty easy. It's like going on a diet; the water weight's the easy part. But going from 4 to 2 might be harder because of service sector inflation, which is totally tied to wages. There's a very strong correlation between wage growth and service sector inflation. That's 60% of the CPI roughly, or the PCE deflator. So getting that final 4% to 2%, that will be the challenge for the Fed. And that's why it's so focused on the labor market here.
Yeah, I think that's a really good analogy. Anybody who's tried to lose weight, those last 5 pounds are always the hardest, right?
That's correct, yeah.
So last question for you, Bill, and thank you very much. This has been a great conversation. What's your advice for investors out there, in this current environment? We're getting towards the end of 2022, starting a new year, and of course, based on everything we've seen in the last few months into what we're expecting in 23.
Yeah, well, it's clearly very easy to be bearish in such a terrible year that we've had here. But when I looked at those previous pivots, I found that 5 out of 6 times in those pivots, equity markets were up over the following year, double digits, and the median was 17% gain from the date of the pivot. And bond markets typically lost about 20% of the starting yield on the day of the pivot. So if it was 5% starting yield, yields went down to 4% over the next 12 months. So you've generally had much better financial market performance, hence the market's focus on this pivot and whether it's coming soon. So, we would say stay constructive. There is clearly a risk that a recession could deliver a hit to earnings. And, I talked to my colleagues, and our head of equities, basically thinks, that the bottom-up analyst consensus may be too high. So there's a potential for a dip that's going to be associated with the aha moment when we find out that earnings are going to be lower. But, historically, if that's coincided with the Fed easing, you often get multiple expansion making up for the earnings. And so I've heard this scenario, dip then rip, where the market could dip, we'll all be scared, and then the Fed will do its thing and it comes roaring back. And I don't think any of us are smart enough to get that timing exactly right. So, we would stay fairly constructive. And our balance funds were 65-35, equities, fixed income. We do think international stocks are interesting here because their valuations are closer to the lower end of their historic trading range going back the last 15 or 20 years, whereas the U.S. is still above its median. So it's an 18 PE versus below 12 in the emerging markets and around 12.5 in the IFA, international developed markets. And the dollar work I did also suggests that in the 1, 3, and 5 years after the dollar makes one of those big surges, you've often had outperformance of the IFA market versus the U.S. market that's pretty substantial. The other thing I'd look at is small caps too. Small caps we think are pretty interesting because they're at 12 times PE if you strip out the non-earners, the small cap universe. So they're almost, I think, fully discounting a pretty severe recession at this point. And if you get a drop in interest rates or just a stabilization, the pause that he said, the pause that is not to be mentioned, small caps have the potential to outperform large caps, I think, by a pretty significant margin.
Terrific, Bill. Thank you. That's very much in line with our Chief Investment Office here at UBS as well. Expect a little bit of volatility with equities in the short term, especially with earnings, but over the long term, the next maybe 8 to 10 years, certainly some substantial growth in the S&P 500, and even with small caps, again, it's a recommendation from our CIO. So thanks for doing that, and thanks for joining us here in the studio, Bill. Great to have you. Let's have you back soon.
Thank you very much. It's been my pleasure.
Good to see you. Anytime. Okay. And for more information, you can visit our website at ubs.com/views from great content from Bill, as well as many of our other partners and our Chief Investment Office here at UBS. Plus, you can follow us on social media. We're on platforms like LinkedIn, Facebook, Instagram, and Twitter. Plus, all of our past UBS Trending episodes are available for you to watch on demand. And as always, if you have any questions about your portfolio or anything that Bill and I spoke about today, please contact your financial advisor. Until next time, I'm Anthony Pastore. We hope you have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.